And we get another one, another big payrolls beat, a complex report that we need to figure out through the next 60 minutes or so. Equity futures positive on the S&P. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Ferro.
Live from New York coming up. Jobs growth in America defying the gloom as the Fed gets one more last word before going quiet. The debt limit deal heads to the president's desk. We begin with the big issue, a week of contradictions. A big increase in job vacancies, jobless claims still ridiculously low, all backed up by strong payrolls growth, contradicted by numbers elsewhere in the jobs report, another weak read on U.S. manufacturing, and a long list of retailers warning about a struggling U.S. consumer. The Dollar General CEO saying their customers are relying more on food banks, savings, credit cards, and then Macy's boss indicating they planned the year assuming that the economic health of the consumer would be challenged, but starting in late March, demand trends weakened even further. All of this leaving the U.S. central bank dazed and somewhat confused ahead of its next policy meeting. Joining us now to discuss is Mohammed El-Erin of Queen's College, Cambridge, and BlackRock's Rick Reeder. Mohammed, first to you. We've got to figure out what on earth is this payrolls report this morning?
So the 14th straight upside surprise. Now there's 20 out of 21 upside surprises. Look, the U.S. economy remains a major engine of job creation, and that is good news. We also know that the U.S. economy is increasingly dualistic between what's happening in manufacturing in general and what's happening in services. And all this, including today's job reports, complicates the Fed's policy challenge, whether you call it a skip, a pause, or hike. It certainly complicates it. And I must tell you, it's going to amplify already the high criticism about communication. People are now going to be scratching their head. Why did they guide the market so strongly towards a skip ahead of this report and ahead of the next CPI?
Rick Reeder, your first take, please.
So, I mean, listen, 339,000 jobs, a lot of jobs. I continue to say, if you go to these component parts, and we talk about this every month, leisure and hospitality, education and healthcare, you're seeing, I mean, they're still not there yet in terms of there's still a tremendous number of workers that have to be higher in those spaces. They're still below the trend line post-COVID. And so that, I think that is persistent. I still think you'll see more of those jobs come in. There's a very interesting nuance to this. You're getting functionally all the job growth you're getting, or the supply of the labor is coming from international, from immigration. And that's part of, you're seeing wages that are coming down a little bit. We're expanding that labor supply. I mean, it's something that you think about what has to happen in UK and Germany, et cetera. But that's a big deal. We're hiring a lot of people, and it's coming from international because you've seen a lot of people leave the labor force that have retired. So that is encouraging. But listen, I think, I still think we're going to be I think the Fed getting to the 4.5 unemployment target or what they've projected is hard.
Mohammed, you mentioned some of the contradictions. I talked about them as well. Let's just dig further into this labour market report as well. The headline number on payrolls, Mohammed, is screaming go again, hike once more in a couple of weeks' time. The rest of the report, Mohammed, does it contradict that to some extent? We get two surveys here, establishment, household. Are they telling you two different things?
Oh, they are. But if you look over time, if you were to take the whole series, then they're telling you a pretty consistent story. And they are telling you, as Rick rightly said, that you have a dualistic economy, that we continue to be strong in terms of labor demand, and we continue to create jobs. Fortunately, the supply side is responding, as Rick said. But the Fed is going to have to make a really difficult judgment. Does it expect the supply side of the labor market to continue to allow wage growth to remain very muted, or will it worry about what the JOLTS data told us? So this is tough. This is getting really tough.
Yields up at the front end by 7 basis points, 441, slightly pricing back in a prospect, the risk, the potential probability that maybe we do get a hike a little bit later this month. Mike McKee dropping by the studio, guys, to catch up with us too. Mike McKee, you've had about 34 minutes to explain this one. What is the explanation?
It's not a particularly good explanation. It is quite a divide between the household and the establishment survey. The establishment survey, as you have been talking about, comes in at 339,000, and April was revised up significantly to 294,000. So still very strong hiring, at least from the company's point of view. And then you have that establishment survey that shows a big drop in the number of people who had jobs, and the unemployment rate goes up to 3.7%. How do you square those two? The average hourly earnings comes in pretty much bang on estimates, although on a year-over-year basis down a tick to 4.3%. But it still suggests, as you did, John, that it's a bifurcated jobs market. We're seeing strong hiring, but the other categories could give an opportunity to the Fed if they want to hold or skip this month. Interesting, in construction, we saw a big gain, 25,000 jobs, and a lot of that is civil construction. In other words, is the Biden IRA plan actually starting to contribute to growth now? Is construction turning around, not just residential, but for the big infrastructure projects? Government, 56,000. You wonder if that's a seasonal thing, because a lot of hiring for schools reported, but schools are getting out in the month of May. Professional services, interesting, because usually that goes down when you're going to see the economy slow. And leisure and hospitality, our favorite category, as Rick was saying, still adding. So where does it leave the Fed? Interestingly enough, the WIRP function on the Bloomberg now shows a 40% chance of a Fed move. Yesterday, it was 23% in June. And here's the lineup. Now, I put the new title on there because really we saw Phillips and we saw Harker say this twice, but it only got Wall Street's attention the last time they did. They haven't really changed their views. And here's kind of the lineup, and the ones who are bolded there are the ones who are voters. So it's about even at this point. Be interesting to see how, if at all, this report affects their views.
Mike McKee, thank you. President Harker, we should skip this meeting. Governor Jefferson early this week, skipping a rate hike at a coming meeting would allow the committee to see more data before making decisions about the extent of additional policy firming. Mohammed, if we got Governor Jefferson back on the phone, do you think the message would change?
I don't know. I mean, I smile a little bit because thinking that 1 month of data is going to make a huge difference is, I think, fooling yourself. But they have framed it that way. And it's a shame because I think it's such a narrow framing, John. We're all now discussing, is it a skip, is it a pause, when there's such bigger issues involved. And that's the risk of being excessively data dependent, is that you get stuck in a sort of small and smaller corner, and the data will pin you there. And as the data becomes fluid, it pins you there even more. You've heard me say over and over again, we need a strategic view of this economy from the Fed, and they need to know where they want to end up, because right now they're excessively data dependent.
Going into the June meeting, Rick, going into this morning even, there was a feeling that we had de-emphasized incoming information going into June because they started to coalesce around the view that they could skip this meeting. I don't think this morning I know what to do with this data when I push it through the bond market, Rick. The market initially sending yields higher by 6 basis points on a 2-year to 440. Others might be looking to fade that. Rick, how are you thinking about that? Have we reintroduced a higher risk now that they do go this month?
Yeah, I mean, I still think I think they're going to pause. If you gave me, but it's not that clear, and we've got CPI report to see. So, and which, by the way, we think is going to be a firm number. So, listen, I think you can pause. I mean, you've moved rates 500 basis points. You will start seeing credit contraction. And people say, when you look into the numbers, I mean, we see it through our platform. All of a sudden, the financing dynamics around where the banks used to lend, we're now being asked in a bunch of different places. You're going to see credit contraction. And the thing I throw out there, we talk about the components of this job report. You lift interest rates, and it hits the cyclical parts. What's clearly slowed is the cyclical parts of the economy. But Mike McKee said construction is different because of the infrastructure build that's going on. But gosh, are you going to really impact healthcare and education hires? Not really. And the question is, can you pause? Can you watch some of this data play out? The data is, the economy is normalizing, and you see it. Is it slower in inflation terms, it is. But boy, we're going to get more data, and I think it's going to tell you economy's normalizing to a more moderate pace, and you can take some time with that.
And in the meantime, by the Nasdaq, Rick, this rip-roaring rally we've seen in the Nasdaq 100, I think this is week 6 consecutive weeks of gains, and this morning Nasdaq futures up again, big time, and doing nicely going into the opening bell. Rick, at the start of the year, it was all about there is an alternative. There is an alternative. You can go to T-bills, money market funds, pick up 4-5%, do what you will. And now it just feels like the fear of missing out is kicking back in, Rick, into the equity market. Do you feel some of that?
100%. I mean, we've led, I'll tell you a couple of things that are interesting around the equity market. The volatility, you look at the VIX index, I think on the prior show we were talking about it. People are not long. It's the reason why volatility is priced so cheaply. People don't need to buy insurance because they're generally not long. You see that in high frequency data. And so, by the way, it's been you can build a portfolio to carry a lot of income and then buy upside convexity in the equity market and can ride some of this move. I think the technicals in the equity market are really good. By the way, you're not getting a lot of issuance. Companies are buying back their stock and people aren't long. You've got this incredible technical, and there's an interesting flight to quality trade going on here. You look at the big tech companies. We've been able to talk a lot about AI, which is true and sincere. But there's also, boy, you look at the cash flow generation. You look at, it's a bit of a flight to quality trade in a lot of these companies is going on. That's not terribly different than keeping some income in the fixed income market in the short end of the yield curve.
One man's bull market, another man's bubble, Mohammed. I'm trying to work out which one it is. I guess it depends whether you're in it or outside of it on the fringes watching it.
So I'm with Rick. Look, the equity market benefits from what I call the notion of all-weather stocks. Stocks that are viewed as either riding a huge secular wave, or alternatively, stocks that are viewed to be insensitive to economic and financial fluctuations. And they have led the rally. In a way, I think equity market participants are very lucky. I feel sorry for the fixed income participants. Imagine we have a Fed policy meeting in less than 2 weeks, and in the last 3 days, the probability of what will happen at that meeting was, as you heard Mike correctly say, 60% hike, down to 20% hike, back up to 40% hike. That is the world that the fixed income people are having to navigate. So relative to them, the equity market looks really very steady and sort of easy to navigate.
Mohammed, if only things were that easy. You've complained about the Fed not taking a strategic view. As a market participant, can you take a strategic view on the direction of things?
So I worry, John, that this Fed will end up pushing the economy into recession. I worry that this will happen for the 3 reasons you know. One is the lack, not just of a strategic view, but of a valid monetary framework. 2 is I think they have the wrong inflation target. And 3, they're trying to restore their credibility. So that's the concern. Otherwise, I think it will be easier to navigate, but the risk of yet another policy error, I fear, is quite high.
Rick said pause in June. That's his expectation, not his recommendation. Mohammed, when we spoke last week, before we had this data, your expectation was rate hike in June. What is it now?
So if they are serious about that 2% target, given the data, they should hike. Okay, if they are true to their word, they should hike because they are data dependent and the data has been hotter than expected. The surprise index, John, is at levels we haven't seen for a very long time, pointing consistently to stronger than expected data. So if they are true to their word and true to their target, they should hike. I would not hike. But then I have sort of broader issues, as you know, in terms of how I would be thinking of monetary policy here.
Mohammed, Rick, you're going to stick with us, I'm pleased to say. The equity market right now going into the opening bell, equity futures just about positive on the S&P 500. Let's get you those movers. We can get to Abby. Hey, Abby.
Hey, John. Well, we're looking at the best day in at least 3 years, I believe, for Lululemon after they put up a big beat and raised quarter. Their adjusted earnings were 16% better than estimates, sales 4% higher. The full year outlook was raised. China is strong and high-end demand staying in place. So the conundrum of different levels of retail continues. MongoDB, the database company indirectly related to AI, they put up adjusted earnings of 56 cents, 200% better than expected. Sales beat, they boosted the outlook, huge upside ahead according to some analysts. Those shares are soaring. And then finally, rounding it out, Cliffs Natural Resources, or Cleveland Cliffs, up 5.3%, the best day since early January. Iron ore is up 2.6%. Steel rebar is up more than 1%. That stock is rallying.
Abby, thank you. China, a massive part of this conversation we'll get to in just a moment. Coming up, the debt limit deal clearing the Senate.
This demanded a bipartisan solution. We knew we'd need to come together for a solution.
The deal the House passed last night is a promising step toward fiscal sanity.
More on that and another big payrolls report with Mohammed Al-Arian and BlackRock's Rick Reeder.
On this vote, the yeas are 63, the nays are 36. The 60-vote threshold having been achieved, the bill is passed.
63 to 36, the Senate passing the debt limit deal with ease.
This demanded a bipartisan solution. We knew we'd need to come together for a solution like the one that passed tonight. And so I'm happy to stand here passing this critical legislation to support our families, preserve vital programs, and most importantly, avoid catastrophic default.
The deal the House passed last night is a promising step toward fiscal sanity. But make no mistake, there's much more work to be done. The fight to reel in wasteful spending is far from over.
The president thanking Schumer and McConnell, calling the agreement a reminder of what's possible when we act in the best interest of our country. I look forward to signing this bill into law as soon as possible. The president set to address the nation this evening from the Oval Office. Joining us now, Bloomberg's Anne-Marie. Morning, Anne-Marie.
Good morning, John. That's right. The president will address the nation this evening, talking about the debt ceiling deal that he got through Congress through a bipartisan fashion. Late last night, it was finished in the Senate, really through the moderates of both parties. One way that Senator Schumer and Senator McConnell were able to assuage some senators' concerns, especially on the GOP side when it comes to these defense hawks, is that they said that this bill does nothing to limit what they can appropriate in emergency spending fashion. So potentially, Jonathan, not quite the exact spending fiscal restrictions we will see if you start appropriating more funds through supplemental means. But this would be a win for the president. And I imagine this evening he will also address what we saw this morning when it comes to those non-farm payroll.
A win for Speaker McCarthy as well. Big win for the president if he wants to talk about the headline number, but elsewhere, slightly confusing. AMH, thank you. Down in Washington, D.C. Rick, onwards, we move on. Hundreds of billions of dollars of T-bill issuance just around the corner. Do you see that being a problem?
There's no doubt. You know, it's funny. I always think, we've all been talking about this debt ceiling. Markets can only do one thing at a time. They can only focus on one thing. Now you just hit on the thing that I think is significant. We're gonna drain $1 trillion of liquidity from the system in terms of bill issuance, $500 billion to replace to replenish the TGA. It's a big deal. I mean, that coupled with the Fed, that is significant. When you drain that much liquidity, it's symmetric to QE. You watch how markets move relative to that. The one thing that I think is different than that draining of liquidity, people have been sitting on their hands for a long time because of all the risk, debt ceiling being a big part of it. There's a lot of money in this system that I think will be able to absorb this, but it's going to be a big focus for the next couple of 3 months.
Mohammed, what does that T-bill issuance compete with directly?
So it competes with what depositors in banks will do otherwise. I mean, what will tend to happen is attract more money out of banks into money market funds. Look, John, there's two things to watch. One is how they are absorbed, and two is market functioning. I'm pretty actually optimistic on both sides that it will be able to be absorbed and the market will function well, but keep an eye on that. More generally, John, and we've taken now two headwinds out of the way. People tend to use the word crisis inadvisably. So people talked about a debt ceiling crisis and a banking crisis.
Yeah.
Well, both crises which never were crises, as you know, but both of them have been taken out of the way. They're no longer headwinds to the economy.
You sound almost constructive, Mohammed, on equity markets in a way that I haven't heard you sound like this for a while.
Oh, no, for weeks now, I've been saying these are fairly priced for what we don't know. Okay, I've always felt that we would resolve the debt ceiling issue. That was the working assumption for most people. They will get resolved, and it has gotten resolved. It's not going to materially change the economic outlook, but there's lots of issues that we don't know, including what we talked about earlier.
A lot of people are in cash, Rick. You were in cash. You've slowly chipped away at that. I think we've been tracking your cash pile over the last several months. Where is that cash pile now, and Rick? And I think we need to talk about that moment for a lot of people who went to cash 4-5%. The decision to go to cash is the first call. The second call is to get back out of it. And I think we often say the second call is the harder decision to make, Rick. What's your advice to those people sat in T-bills right now, sat in cash?
I'll tell you, I would still own a bunch of them. I mean, at the end of the day, I mean, you can. This is a pretty. You made the point about for fixed income, it's a tricky period. It is a tricky period, but there are a couple of things that I think are really powerful. One is you can carry really high. You're talking about this bill issuance. You're talking about buying. You can buy 1 to 3 year maturity investment grade credit. And by the way, in Europe, swap it back to dollars, get over 6%. That's pretty good. I mean, you're not taking credit risk. You're not taking really any significant interest rate risk. So you can do, so there's that to do in the markets. And I think people, will continue to put money into these, to what are some pretty significant yields that you haven't seen in the past in quality assets. And then the second thing, Jonathan, that I think is critical, we lived for 10 years in zero rate environment or low rate environment. And financial assets became potatoes. It didn't really, they were, all the same, they all went up or they all went down because you had massive monetary policy. Now you're getting massive dispersion. And one of the things that's interesting in fixed income now, emerging markets are interesting relative to some of the credit markets because of different inflationary dynamics. You're seeing real defaults in places like commercial real estate, parts of the lev loan market. So there's things to do in fixed income today that I think, particularly if you can actively manage it in today's environment, it's really interesting. I would argue there's not a big fat pitch for, is there a big rate trade? But I think there's a lot of things to do now, given we're going to see more volatility, more dispersion intra a lot of these markets.
One thing we can agree on, this market ain't boring right now. Rick Reeder, Mohammed Al-Erin, to the two of you. Wonderful. What a privilege, a pleasure to do this with you guys every first Friday of the month post payrolls. Big report from the payrolls report. Coming up, the morning calls and later, US jobs growth defying the gloom. More on the latest report with Anastasia Amoroso, PGIM's Mike Collins. That's still ahead. On track for another week of gains in the equity market. The S&P firmer, the Nasdaq higher, the Russell ripping going into the opening bell. That's the price action. Let's get you some morning calls. Bank of America upgrading universal health services, expecting better margins. Jefferies raising its Apple price target to 2 cents, saying next week's developers conference will serve as an upside catalyst. And finally, Piper downgrading Dollar General, highlighting a notable decline in quarterly comps. More on the retailers coming up shortly. We'll catch up with Anastasia Amoroso of iCapital and Mike Collins of PGIM. That's next, your opening bell, just around the corner. Big question going into payrolls. What on earth do you do with that payrolls report? Top line really strong, the rest of it not so much. Equity futures positive, dancing higher by 0.66% on the S&P. The Russell outperforming. The big cap tech story continues for a 6th consecutive week. Looking for another weekly gain. That's the price action in equity. Switch up the board and get to the bond market. Yields a little bit higher by a couple of basis points on a 10-year maturity. Back through 360. The bigger move at the front end on a 2-year. All over the place post payrolls, but higher now by 5 or 6 basis points, just short of 440. A touch of dollar strength briefly. It fades. The euro just about unchanged against the dollar. Euro dollar 107.69 and crude higher by 2.5%. Commodities up today off the back of speculation that we get some stimulus from China and reporting from the team here at Bloomberg that maybe China is considering doing something around the property market to support things just a little bit more. 30 seconds into the session, the broader equity market opens higher by almost 0.7% on the S&P, on the Nasdaq up by 0.8%. One stock to watch at the open, Lulu, topping Q1 earnings estimates and delivering a better than expected outlook. The CFO saying this: a meaningful acceleration in our China sales coupled with lower freight costs contributed to our better than planned performance. Abby has more. Hey, Abby.
Hey, John. Well, after 9 down days in a row, Lululemon, that was the longest losing streak for the stock going back to 2016. It is now up more than 15%. Its best day since June of 2018. And it has everything to do with that China strength that you were just talking about that allowed them to beat adjusted earnings by 16%. Sales were better by 4%. As you mentioned, they raised the full year outlook. A lot of it having to do with that China strength. It also has to do with the fact that they are finally moving through their bloated inventories. They rose just 24% from a year ago in the first quarter when they were up 50% year over year. Gross margins expanded. Executives at the company are saying that has a lot to do with China. They're also planning on opening 30 to 35 stores, many of them in China. So that China rebound that everybody's been waiting for, at least it's there for Lululemon. And it's interesting, John, because retail has been so mixed this year. This is another one of the brands, the higher end brands that retail consumers seem to be flocking toward. They're fashion right and being willing to pay up for this brand. Again, this stock right now up about 15%.
Abby, never mind this year, the last 24 hours. Just a story of contradictions. And Abby, thank you. Abby, looking at Lulu there, absolutely fine, flying. Nordstrom just about holding on. Macy's terrible. Dollar Tree telling you an ugly picture for the US consumer right now, and retail all over the place. Lulu right now up by close to 15%. I want to talk about the banks, the financials. Goldman warning of a 25% decline in trading revenue for the second quarter. The President John Waldron saying, quote, it feels like we're going to have a contractionary environment for a period of time. We're now embarking on additional targeted action with headcount. Kaylee has more. Hey, Kaylee.
Hey, John. Well, interesting to see Goldman actually positive here at the opening bell by about 0.4%. But we have to keep in mind the week through yesterday's close, it was down about 4.7%. So this rebound isn't likely to end in a weekly gain for this company. Of course, earlier in the week, we did get reports from here at Bloomberg that Goldman is looking at another round of job cuts, less than 250 jobs this time around. But that's after they cut 3,200 back at the beginning of the year and several hundred last fall. So the third round of cuts in less than a year, as they are contending not just with a 25% slump in the trading business, but other areas as well. Waldron talking about sluggish capital markets activity, the slowdown in deal making that is weighing on investment banking fees as the macroeconomic environment is just more difficult. And we heard echoes of this from Morgan Stanley as well. The co-president, Andy Saperstein, speaking on Wednesday, also said he expects that this quarter will be down year over year, that sales and trading is softer. Investment banking is very challenged, and the industry has been what he described as a sustained trough since last year in investment banking. For Bank of America, though, John, the story is a bit different. We heard from Brian Moynihan, the bank's CEO, yesterday, saying that he expects trading and sales activity to be flattish this quarter. We have to keep in mind, though, that Bank of America is coming from a bit of a different base because it didn't have quite the performance in that division last year as some of the rivals did.
The bank's doing better today. Kelly, for the wrap there. Thank you. Down in Washington, D.C. Nothing defensive about this equity market this morning. The underperformance from utilities, healthcare, the outperformance from materials, consumer discretionary, energy. There's a bit of an attacking pose to this equity market right now, up by 0.9%, even with the yields drifting higher at the front end by 6 basis points back through 440 on a 2-year. The slowdown weighing on earnings from Dow, though, feeling the pressure from weaker consumer PC demand. The company delivering a tepid outlook despite topping Q1 estimates. The stock just about positive. Katie has more. Hey, Katie.
Hey, John. Well, it wasn't as bad as feared, but it still wasn't good. We know that personal computers have been a tough sell. We saw that from HP earlier in the week. We saw it again from Dell today. So let's get specific here. Consumer PC sales plunged 42% in the period ended May 5th to about $2.12 billion. Analysts had been looking for about $2.3 billion. They did fare slightly better when it comes to commercial PCs. That segment brought in about $9.9 billion of sales, which was an 18% decline, but it still beat estimates. It was the outlook, though, that was lukewarm at best. Dell sees revenue between $20.2 billion to $21.2 billion in this current period. Now, on average, analysts had been looking for about $21.1 billion, so at the upper end of Dell's range. You look at what the stock is doing, and it's interesting. It had been lower pre-market. It's bouncing around right now, currently up about 0.5% or so.
Katie, thank you. I'll show you a bigger move than that. Year to date, and Katie, thanks again. Year to date, Apple up by close to 40%. Shares of Apple inching ever closer to an all-time high. We got two analysts raising their price targets today ahead of next week's developers conference. Morgan Stanley writing this: the combination of technological improvements and lower price points of the AR/VR headsets is what could make a conference a more significant stock catalyst this year. That stock up just a bit, 181, up by 0.6%. Want to stick on tech? Here's a story for you, buried by the news around the payrolls report in the last hour, but what a story. Bloomberg learning that Amazon has been in talks to offer mobile service to its Prime members in the United States. The report sending Amazon higher and telecoms lower. Ed Ludlow on that breaking news of the last hour or so. Morning, Ed.
Yeah, John, there's a lot to cover here. These are some pretty monster moves in reaction to this Bloomberg reporting. According to sources, Amazon is in talks with Verizon, T-Mobile and Dish. The idea, according to sources, is to get access to wholesale prices and then offer a low price, $10 per month or for free, to Prime members to give access to a wireless network. You look at Amazon up 2.3%, but I think we better take a quick look at the networks themselves, the carriers themselves. Dish is up now the most since 2011 at one point, up 19%. The idea is that, according to sources, it would give higher utilization for these newly built 5G networks. Whenever Amazon enters a new product category, it sends shivers into that industry. And you look at the reaction to the downside, Verizon, AT&T and T-Mobile. T-Mobile down 7.6%. That is the biggest drop since March of 2020 on that particular stock. The reasoning being that Amazon can undercut pricing because of its flex financially. So really interesting to see what this means for Prime, but also the future of those carriers.
Fascinating story. Ed, thanks for that. No doubt you and Caroline Hyde will be talking about this a little bit later on Bloomberg Technology. Look out for that in about 2 hours and 20 minutes time on Bloomberg TV. Amazon is doing okay. Dish Network's flying. The rest of the telecoms, it's not looking good out there at all. For the broader market, it's looking okay, better than okay, up 1% on the S&P 500. I mentioned there's so much going on right now, away from the payrolls report. You've got the China stimulus story, which we can talk about right now. Bank of America's Michael Hartnett writing the following this morning: the tech stocks have discounted a June Fed pause, leaving China stimulus as the bullish June surprise. He says the contrarian call here right now is to buy the Hang Seng and sell AI. Think about the beaten up parts of this market: commodities, EM, resources and banks. And right on cue this morning, China is said to be considering a new package of measures to boost its economy and support the property market. That's one we'll be talking about going through the weekend. For us right now, we get lucky again. Joining us is iCapital's Anastasia Amoroso, alongside PGIM's Mike Collins. Anastasia, you get lucky too, because you've had about an hour to think about this labour market report, because everyone else is still confused by it. What's your take on it?
Well, look, I don't think the report is really as buoyant as the payrolls number actually suggests, because when you look at the household survey, and I do focus on this one a little bit more in this particular report, it is a more expansive measure that takes into account the self-employed people and household workers. And, you know, if you look at that, you do see a little bit of weakness, or at least loosening up in the labor market that's emerging. So I think the Fed is going to focus on that. The Fed is going to focus on the fact that wage growth is running a little bit slower this time around than it did the month before. So I actually think that's a positive, and that's how the markets are certainly interpreting in this. You know, I will say the Fed also has plenty of reasons to keep on hiking rates, because the data, the economic surprise continues to be so resilient. But in a way, they've sort of pre-committed to a pause. And I think, given, again, you know, the weakness in the 3.7% unemployment rate, I think they can have enough credibility to pause in June.
Mike Collins, is so confusing. The labour market data at the very headline, payrolls growth this morning, together with claims earlier this week, job openings earlier this week, says there's nothing to see here, no problem. Then you go to the retailers and they're screaming, we've got a discretionary recession. Mike, which one is it?
Yeah, it's a lot of churn, Jonathan, and as Rick Reeder said, a lot of dispersion between winners and losers, not just in corporations, but among people, right? You are seeing that lower income bracket. As Mike McKee reported, African-American unemployment rate is jumping. You're seeing more distressed and highly levered companies really suffer in this environment. So that's something that everybody, including the Fed, really has to keep an eye on. But our base case, you know, when you see this volatility of numbers and it's really difficult to parse them, you step back, say, where are we heading in the big picture? And the base case is that, you know, growth is moderating. We're probably going to be running at 1% GDP in this country over the next 12 months. Inflation is moderating. We'll probably be running at a 3% inflation rate over the next 12 months. You add those together, you get 4% nominal GDP. That's not a world where the funds rate should be 5, nevertheless 6. I think to talk about taking it to 6 is kind of crazy. The markets, as you know, are pricing in one more full hike over the summer. And then kind of remarkably, 200 basis points of cuts from there pretty quickly over the next 17 months or so. So that's a real aggressive set of cuts, maybe overdone.
The environment you described, Mike, sounds like by the NASDAQ 100. The NASDAQ 100 year to date is up by 33%. It's just a phenomenal rally. Anastasia, you've been constructive on tech. You've been constructive on this market. I remember several payrolls reports ago, you talked about breaking out of this tight trading range of 23 to the upside. Anastasia, we've done that. Can you make the argument now with conviction that now is the time to lock in some profits here?
Look, I think in parts of the market, it is absolutely the time to lock in partial profits. And in particular, I am looking at the NASDAQ. I'm looking at the semiconductors. I mean, the rally in semiconductor stocks, for example, has been stunning year to date. It's up 65%. And especially in the last couple of weeks, the semiconductor space has gone parabolic, which we all understand why, because semis are the key enabling technology of artificial intelligence. But anytime you see something move to the upside so far, so fast, so parabolic, you know, you get into an overbought territory, and that's exactly where we are today. And then also, John, I look at the valuations of the semiconductor stocks, and the SOX index, for example, the valuation expanded from 13 times multiple at the October lows of last year to 28 times today. And don't get me wrong, I'm a huge believer in the semiconductor story and the artificial intelligence story. But if I take a tactical investor perspective near term, that's a sector that's looking stretched on positioning, on valuation, on technicals. And so for those reasons, I would want to take profits. And by the way, you know, when you have this setup, you always are waiting for some sort of a negative catalyst. And we don't know which way the Fed is going to move in June, but I think there is scope for a hawkish surprise given how resilient the data has been. So if we have to reprice the path of Fed policy higher, then I think that's the ultimate negative catalyst for semiconductors. By the way,
for that debate,
I want to buy it.
As you know, CPI on June 13th. Mike Collins, if we do leave these growthier parts of the equity market tech, you've got to make a decision whether you want to go back into the cyclical trade again. Mike, the cyclical trade just seems to have broken down. China disappointing, Europe disappointing. We reported earlier this morning that China might be considering stimulus measures. Mike, what gets that cyclical trade going again?
You know, the Fed pausing for sure, not only skipping, but kind of signaling eventually, maybe over the next few months, that they really are done or really close to done. And the market's pricing of all these cuts have to continue to be in place, right? If the whole yield curve elevates higher toward that 5.25 funds rate, there's more pain to come, right? Multiples will compress, credit spreads will widen, the economy will weaken. So these cuts that are priced in may be aggressive in the near term, but wow, they have to really be sustained there for the economy to continue running.
Mike Collins is going to stick with us alongside Anastasia Amoroso. Coming up, the Fed's last word before going quiet.
We're getting close to a point where we can sit for a little bit. We really should skip, not pause. I don't like the word pause.
That conversation up next with Anastasia Amoroso and Mike Collins.
We're getting close to a point where we can sit for a little bit in terms of policy. I don't know if we're exactly there yet, but I am in the camp increasingly coming into this meeting of thinking that we really should skip, not pause. I don't like the word pause, but skip an increase.
The committee at the Federal Reserve finding consensus on at least one thing. Don't call it a pause, call it a skip. Governor Jefferson leading the way this week. Skipping a rate hike at a coming meeting would allow the committee to see more data before making decisions about the extent of additional policy firming. President Harker backing him up in many ways. We should at least skip this meeting in terms of an increase. We can let some of these things resolve themselves, at least to the extent they can, before we consider at all another increase. Federal Reserve officials getting in the last word ahead of the quiet period going into the next decision in just under 2 weeks away. Anastasia Amoroso, Mike Collins back with us. Anastasia, you mentioned this, and forgive me for jumping in a little bit prematurely, with regards to the Fed's next move. Morgan Stanley's Ellen Zentner saying this after the payrolls report. We do not believe today's report was strong enough to meet the bar for the Fed to hike in June, but it raises the risk that the Fed could hike in July. Anastasia, is that the way you're thinking about it too?
I think that's the scenario, John. I mean, if the Fed didn't really pre-commit, if the Fed didn't really make all the statements about the potential to have the leeway to pause, I think they would probably go in June. But, first of all, it's still only been a couple of months since the banking turmoil, and it's really just subsided in the last month or so. Second, the data has been somewhat mixed. So I think that does give the Fed some flexibility. But the main point is that Powell really said pretty strongly, saying we have the luxury to wait, given how much we've tightened already. And I think they're likely to use that luxury. And here's the thing, John, we've had the Fed who went from hiking 75 basis points to hiking 25 basis points. But the next part of the tightening cycle may be that they maybe hike once a quarter. And, if that's the case, then, July might as well make sense.
We spoke to Mohammed in the last 50 minutes or so. Take a listen to what he had to say about the Fed's next move.
We also know that the U.S. economy is increasingly dualistic between what's happening in manufacturing in general and what's happening in services. And all this, including today's job reports, complicates the Fed's policy challenge. Whether you call it a skip, a pause, or hike, it certainly complicates it.
And Mike Collins, it makes it complicated for all of us. Mohammed mentioned what was happening beneath the surface of the economy. Manufacturing is screaming cut rates, services screaming you could stay where you are, maybe even hike. Mike, what are you meant to do with that information? How much weight do you put on each?
Yeah, it's really tough, right? And the markets are kind of right in the middle. They're pricing in about half of the hike in June and the other half in July. So they're pricing in one more hike for the cycle, which feels about right. It's hard to argue against that. But again, by the time, if they do skip in June, Jonathan, by the time the meeting in July, which is almost 2 months from now, our best guess is that you will continue to see more evidence that growth and inflation are moderating, and the Fed will probably be done for the cycle if they skip in June, would be my guess. And remember, you have to take all of the hikes into account, not just at the Fed, but globally. You add all the rate hikes around the world, Jonathan, over the last couple of years, it is multiples of anything we've seen in our lives. You add quantitative tightening, and as Anastasia said, the bank lending standards tightening pretty significantly. All that points to the funds rate is as high as it should go for the cycle.
I said this a little bit earlier. There's nothing boring about it right now. That's for sure, trying to work out all this stuff. Mike Collins, Anastasia Amoroso, to the two of you, thank you. Just always a stellar lineup on Payrolls Friday, and appreciate your time, as always, too. The equity market on the S&P 500, positive by 0.8%. The Nasdaq positive as well. The Russell doing nicely. In the bond market, yields were higher off the back of the report, higher again by 9 basis points at the moment, 443 on a 2-year. Further down the curve, 10-year maturity yields up there by 5 to about 365. Let's get you some sector price action. Here's Abby.
A solid rally for the S&P 500 indeed, John. In fact, the index is heading to its third up week in a row, the longest weekly winning streak since March. As for today, not surprisingly, with the strength, we have most sectors higher. In fact, we have 6 of them higher by more than 1%. Materials and energy, the top sectors, up about 2% or more. All the stocks in each of those sectors are higher. That's the kind of strength we're seeing today. As for the AI rally, it is strongly in place over the last 2 weeks. It's interesting, though, John. Earlier, NVIDIA had crossed the mark to $1 trillion market cap. Again, that stock now down. But over the last 2 weeks, you can see that tech, the stocks, NVIDIA and C3 AI, all on fire as the AI craze continues.
Over the last 6 weeks, NASDAQ 100, sixth weekly gain, longest weekly winning streak going back to July 2021. Abby, thank you. Up next on this program, we'll get you to the weekend. We'll take a look at the trading diary into the weekend and beyond. Equities positive on the S&P 500, up again on the NASDAQ. Connor Russell doing nicely here. Going into the weekend and beyond, let's get to the trading diary. It looks a little something like this. President Biden speaks at 7 p.m. Eastern time about avoiding a default. OPEC Plus meeting in Vienna over the weekend. We get U.S. durable goods and ISM services numbers on Monday, plus Apple hosting its Worldwide Developers Conference as well. The UK Prime Minister Rishi Sunak visiting President Biden in Washington on Wednesday. And finally, got another round of jobless claims coming up on Thursday. Just a programming note, on Tuesday, I'll be flying out from the East Coast to the West Coast and catching up with good people over at PIMCO. Manny Roman, Dan Iverson, fantastic lineup. Some of the best people out there, including the former Fed Vice Chair Rich Clarida as well. Tiffany Wilding, all of the above. You think of the name? They're going to be with us on Tuesday on the West Coast live from California. I'll see you then.